The stock market has always been a roller coaster ride, marked by exhilarating highs and gut-wrenching lows. Throughout history, we've seen multiple crashes that triggered panic, anxiety, and widespread economic uncertainty. As we approach the predicted stock market crash of 2024, there's no shortage of experts and pundits warning us of impending doom. Media outlets and analysts have been sounding the alarm, advising people to brace themselves for what could be a financial apocalypse. The narrative is frightening. The economy is weakening, inflation is still a concern, and interest rate cuts are signaling further instability. But what does this all really mean for the average investor? Are we on the brink of a devastating collapse? Or is this just another chapter in the stock market's long history of ups and downs? It's crucial to understand the facts, filter out the fear, and make informed decisions. One of the most discussed topics right now is the Federal Reserve's recent decision to cut interest rates, which has stirred mixed reactions. Some argue that this move indicates deeper economic trouble, while others view it as a potential spark for market recovery. So before rushing to any conclusions, let's take a closer look at what's really going on. One of the primary drivers of the current market uncertainty is the Federal Reserve's decision to cut interest rates by 0.5 percentage point. The first rate cut in 4 years. By the end of 2024, we're expected to see interest rates hovering around 4.5%, and by the end of next year, potentially 3.5%. By early 2026, interest rates could reach as low as 3%. But what does this mean for the stock market? There are two prevailing schools of thought. Some analysts believe that rate cuts could send the stock market into a downward spiral. Historically, the market has reacted negatively to rate cuts under certain conditions, especially if those cuts are made in response to a struggling economy. On the other hand, rate cuts have also been associated with stock market rallies when the economy is relatively stable. So which one is it? The truth is that both outcomes are possible, and it all depends on the broader economic landscape. If the economy is in decent shape, lower interest rates can boost stock prices, as cheaper borrowing costs stimulate business investment and consumer spending. Historically, the S&P 500 has performed well during periods of rate cuts, particularly in non-recessionary environments. For instance, during 4 separate rate cut cycles over the past 40 years, the S&P 500 delivered substantial gains: 21% in 1998, 19% in 1995, 33% in 1989, and 22% in 1984. But if the economy is already in a fragile state, rate cuts may not be enough to prevent a downturn. It's like giving medicine to someone who's already critically ill. Sometimes it helps, and sometimes it's simply too late. So the real question we should be asking is, how bad is the economy right now? There's no doubt that the economy is facing challenges. Unemployment has ticked up, inflation remains a concern, and overall consumer confidence has been shaky. However, the situation is not as dire as some headlines may lead you to believe. While we're certainly not in a period of robust growth, we're also not in a full-blown recession, at least not yet. The crucial point to keep in mind is that no one can accurately predict the future of the economy with 100% certainty. Economic forecasts are inherently uncertain, and trying to time the market based on fear or speculation is a risky game. What we do know is that over the past 15 years, despite several market crashes and economic crises, the stock market has shown remarkable resilience. In fact, the S&P 500 has increased by 700% during that time. That's right, 700%. From the 2008 financial crisis to the COVID-19 pandemic, from political upheavals to trade wars, the stock market has continued its upward march. Investors who stayed the course during these tumultuous periods were handsomely rewarded, while those who panicked and sold likely missed out on significant gains. It's easy to look back and say that staying invested through market downturns is the right move, but in the heat of the moment, fear often clouds judgment. Let's take a quick trip down memory lane and examine some of the major events that shook the markets over the past decade and a half. In 2010, the flash crash sent the market into a brief tailspin, but it recovered almost as quickly as it fell. In 2011, Japan was hit by its worst earthquake in modern history, leading to fears of global economic disruption. That same year, the U.S. credit rating was downgraded, and Europe faced a sovereign debt crisis. Each of these events sparked panic, with headlines predicting market chaos. Yet, the S&P 500 kept climbing. In 2015, the Brexit vote sent shockwaves through global markets. And in 2019, the trade war between the US and China caused significant volatility. Then in 2020, COVID-19 brought the world economy to a screeching halt. The stock market plunged in the early days of the pandemic, and many investors feared a prolonged bear market. Yet, within months, the market had rebounded, and by 2021 it was setting new all-time highs. The lesson here is clear. The market is incredibly resilient, and history shows that it recovers from even the most severe crises. Those who panic and sell during downturns often miss out on the inevitable recovery. In contrast, those who stay invested through the tough times typically come out ahead in the long run. It's human nature to want to act when things feel uncertain, and the media is notorious for amplifying both euphoria and fear. When the market is up, they tell you it's a bull run, and when it's down, they urge you to sell. This constant barrage of conflicting advice can be overwhelming and lead to impulsive decisions. But here's the thing. Panic selling based on short-term market movements is a surefire way to lose money. Take the example of August 5th. On that day, the market dropped by 10%, and many investors panicked. Some sold their stocks convinced that the crash was just beginning. Yet a few weeks later, the market had rebounded, and those who sold missed out on the recovery. This kind of short-term thinking can be incredibly costly. The stock market is like a rubber band. It stretches, bends, and sometimes even snaps back violently, but it rarely breaks. Historically, markets have recovered 100% of the time given enough time. It might take months or even years, but the market has always bounced back from downturns. Let's say you had started investing in 1998, right before the dot-com bubble burst. You experienced one of the most significant market crashes in history, followed by the 2008 financial crisis. Despite these downturns, if you had invested $100 a month consistently, by January 2022, your total return would be nearly 200%. The secret? You stayed invested, even during the most challenging periods. The stock market is a long-term game, and those who try to time it are often left disappointed. In fact, missing just the 10 best days in the market over the past 20 years could cut your returns in half. That's right, just 10 days. The takeaway? Don't try to time the market. Stay invested and focus on the long-term picture. One of the most powerful forces in investing is compound interest. When you invest in the stock market, you're not just earning a return on your initial investment. You're earning a return on your returns. Over time, this creates a snowball effect that can lead to significant wealth accumulation. For example, if you had invested $10,000 40 years ago and earned an average return of 10% per year, the historical average for the S&P 500, your investment would have grown to $1.1 million today. That's the power of compound interest in action. And this is why Warren Buffett famously said, "People want to get rich, but nobody wants to get rich slowly." The key to building wealth in the stock market is patience. The longer you stay invested, the more your money grows, thanks to the magic of compounding. There's an old saying in investing: buy when there's blood on the streets, even if the blood is your own. In other words, the best time to buy stocks is when everyone else is selling. During market crashes and periods of panic, stock prices are often undervalued, presenting an opportunity for savvy investors to buy at a discount. While it's counterintuitive to invest during times of fear, history shows that those who do are often the ones who come out ahead. So, as we approach the predicted stock market crash of 2024, remember this: stay calm, stay invested, and, if you can, take advantage of the opportunities that arise during times of uncertainty.